Hi, this is Matthew Seymour, and I'll be covering the health of the US Treasury Market. Due to America instituting tariffs and engaging in trade wars, there has been the notion that foreign money would pull out of our financial systems, such as the stock market. Articles such as this one from JP Morgan raise fears of that concept. And so here's a recently cited example, the market for the 2-year note. This has been described as a problem for the Treasury, or that the market for Treasuries is in trouble. This chart is a little misleading, as not every Treasury duration looks like this. And in this video, I'll break down some data and show you if these current auctions are anything to be worried about. Here is a one-pager provided by the US Treasury to show the results of a Treasury auction. This is how America finances itself, so the show can go on. Just from looking at this, it's not really going to tell anybody much of anything about how we are doing. So to understand where we are right now, we need context. And that context is best provided by choosing historical examples of financial institutions struggling. So I have chosen 2 periods of data. The first got really bad, the Great Financial Crash. The second is less bad, but still a little scary, and that was just 2 to 3 years ago. So the first period will feature the 4-week Treasury auction around the Great Financial Crash. This chart covers 2006 to 2007, and there were, as you all know, big problems in the subprime category of mortgage lenders. A few of them went bankrupt, but nobody really cared, as everyone thought the issues were contained. I mean, it is the riskiest class of mortgages. It having troubles now and again were not supposed to be surprising. Equities were setting record highs, and Treasury auctions were normal. The 4-week auctions are weekly, and since the duration was as short as sold by the Treasury, if trouble strikes, we will know it fast. But so far, the spread between the highest bid and the median bid of a Treasury auction was really tight. This looks about as healthy as you can get, and there's definitely no panic to be found in the land of Treasuries. Everything is within one standard deviation of average. But then trouble does strike. On August 6th of 2007, the subprime mortgage problem spread, and the first major lender went bankrupt that was not exclusive to subprime. They also did Alt-A or near-prime loans, which were supposed to be safe, or, well, less risky. This created panic, big panic, and over the next 2 weeks, global lending across banks froze up and stopped completely. It took 3 months after the mortgage lender went belly up for the spread between high and median bids to almost get to the old +1 standard deviation above average line. But 1 month later, the recession had officially started. We'll still keep the old standard deviation bands from before the troubles started to help provide context. Zooming out to cover all of the recession, we'll see how volatile the spreads got. Lehman Brothers went bust in September of 2008, and that is the second large spike in spreads. This created mass panic and a large flight to safety, and that safety was the US Treasury Market. By July of 2009, right after the recession had officially ended, the spread was back to being tight and in the old pre-troubles range. One last tidbit about the 4-week auction during the Great Financial Crash. One metric covered perhaps most frequently in financial media when discussing Treasury auctions is bid to cover. Bid to cover is a simple equation, which is taking the size of all of the bids and then divide that by the size of the auction. In real world terms, the bid to cover cannot possibly go below 1. That is the minimum. It's normally double to triple that. Yet bid to cover hit 1.11, so almost 1, after the first multi-risk class mortgage lender, so not just subprime, the one I mentioned previously, went under in August of 2007. This chart here shows a bid to cover metric I created called bid to cover against expectation, where against expectation is set to 0. We can see the severe negative candle in August of 2007. That is way below anything else. Now look to the right of this chart, and we can also see how strong the auction became as part of the flight to safety towards the end of 2008. This wraps up our first historical example. This shows an extreme case of spreads widening and bid to cover getting funky to show true panic in Treasury markets. Our second historical example was recent. This chart covers over 3 years of auctions up to the most recent Treasury auction. The historical example is a combination of factors in the early part of this chart, and it begins with uncertainty about where yields should be as the Federal Reserve rose rates to fight inflation. Then it gets a shock as a few banks go under, small banks, While over-leveraged on underwater bonds, they could only sell at a large loss. Fears caused an old-fashioned bank run at the most notable of these banks, SVB or Silicon Valley Bank. Their bond holdings had declined in value so much that it could not sell them to raise capital necessary to handle the bank run. So foreign money might have pulled out of the forward treasury market a little lately, but it's still currently healthy. The spreads here are fine if you look at the right of the chart. They're not narrow, but they are stable. That spike in the beginning of July was due to Congress and a debate about the debt ceiling, and then it fell back to the same range of spreads as before. For reference, here's how the 2-year Treasury bond reacted to interest rates rising and SVB going bust. Some volatility, but not too much. Spreads are not narrow, but they're contained. The y-axis is 1/3 the size of the 4-week Treasury. Getting into details here, if we split this 2-year chart up, then standard deviation towards the right third of the chart is almost the exact same as the left third of the chart, back when rates had not even begun to rise. Silicon Valley Bank was just a bump in the road for the 2-year. So each Treasury duration can be its own animal, but the longer durations were much less worried. It helps when auctions are once a month for notes and bonds versus once a week for bills. They become less reactionary. Remember the first chart at the beginning of the video with money leaving the market for 2-year Treasuries? Well, I feel like I can't end the video without using everyone's most common benchmark duration. Here is the 10-year. It really is its own animal, and it is a much smaller animal. The 10-year is only 58% of the size of the 2-year and 42% of the size of the 4-week auction. The 10-year Treasury is really not how the government funds itself, but it is used as a popular benchmark for businesses to base financing decisions off of, and mortgages. So the right chart shows the spread between high and median bids were similarly affected by the change in interest rates and Silicon Valley Bank going under, but recently have begun narrowing. The spreads are fine. The left chart shows none of the decline in foreign money that the 2-year showed. Each duration has its own pool of buyers, and sometimes there's just not much overlap between those pools. So is the Treasury market in trouble? No, it's not. Foreign money pulling out of the 2-year is interesting and something to follow, but bid to cover is not showing anything too unusual besides normal reaction to a debt ceiling problem that has now been resolved. And spreads between bids for American debt are in a normal range. This country funds itself mostly through short-term treasuries or T-bills. So that's probably what I'll be covering in my next video. Until next time.